Picture this. After 40 years of hard work, you finally retired. You did everything right. Built up savings, contributed to your 401k, bought a few stocks, some real estate in your city, and even have a few bitcoins. But 3 years into retirement, you're watching your bank account shrink. Your stock portfolio is down 30%. Your real estate investments are demanding expensive repairs. And those bitcoins that your nephew convinced you to buy, they've lost more than 25% of their value. This isn't just a story. This is happening to millions of retirees right now. People who did everything by the book are now watching inflation eat away at their savings. They're now borrowing money from their kids or are having to move in with them completely. As embarrassing as it sounds, it doesn't have to be your story. If you act now, you can retire with dignity by earning reliable dividend income that grows year after year. That is what this video is about. I'll reveal to you the 3 best dividend stocks that can generate reliable income in your retirement. We'll also see what's possible when you invest $100,000 in each using the DRIP strategy. But first, let's understand what makes these stocks perfect for retirement. There are 3 critical qualities to look for. First, the company must generate strong free cash flow. Think of free cash flow as the actual money a company is left with after paying all its bills and investing in its business. It's like your take-home pay after all your expenses. The more free cash flow a company has, the more reliable its dividend payments will be. Second, and the most important, the company must use only a small portion of its free cash flow to pay dividends. For example, if a company earns $100 in free cash flow and pays out $40 in dividends, that's great. It means they have plenty of cash left over to grow the business and handle any unexpected problems. Third, the company must be increasing its dividends for at least 10 years straight. This shows they're committed to rewarding shareholders, even during market downturns and recessions. Take AT&T, for example. The stock is a strong buy with a juicy 6.4% dividend yield. Or, that's what retirees who invested in it thought. AT&T was paying most of its free cash flow in dividends every year, leaving little room for error. From 2019 to 2024, its stock price fell from $23 to $19 due to failed investments in DirecTV and Warner Media. Very soon, their debt piled up, and the situation forced them to cut dividend payments. Those retirees who depended on AT&T's dividends, their retirement income took a serious hit. This is why we need to be smarter and look beyond just high dividend yields. Let's now discuss the 3 stocks that truly meet all these critical qualities. First up, we have Visa, ticker symbol V. Visa is a dividend monster hiding in plain sight. Unlike many people think, Visa is not a credit card company. They are a data network company that sells its payment processing network to debit, credit card, and other payment companies. They take a small cut from every transaction they process. In 2024 alone, they processed over $16 trillion in payments. Their network handles more than 65,000 transactions every second across 200-plus countries. Visa doesn't lend money or take credit risk. They simply collect fees to process these transactions. Here's how Visa crushes all 3 qualities we look for in a retirement stock. First, their free cash flow is incredible. In the last 12 months, they generated $19.7 billion in free cash flow from $34.4 billion in revenue. That means for every $100 in revenue, Visa keeps $58 as pure cash flow, one of the highest rates in the Fortune 500. Second, Visa uses only 30% of this free cash flow to pay dividends. The rest, they use it to buy back shares and grow the business. This helps them to be resilient in tough times like a crash or economic slowdown. Third, they've increased their dividend for 15 straight years, including through the 2008 financial crisis, the pandemic, and every market crash in between. Their average dividend growth rate, an impressive 14.43% per year. Looking at their current numbers, at today's price of $267 per share, they pay a dividend of $2.08 per share annually. While the 0.8% yield might seem modest, here's what happens when you invest $100,000 into Visa initially and reinvest those dividends every quarter. In 5 years, your annual dividend income grows to $7,240. In 10 years, that $7,240 accelerates to $14,180. In 15 years, it compounds to $27,760. And in 20 years, it generates an incredible $54,320 per year. What makes Visa exceptional for 2025 and beyond is that they're the undisputed leader in digital payments as the world moves away from cash. Every time you tap your phone to pay, shop online, or send money abroad, Visa takes a cut. Their network is so vast and secure that even tech giants like Apple and Google chose to partner with them rather than compete. Their business model is practically immune to inflation. When prices go up, their revenue automatically increases as they take a percentage of each transaction. Next up is Microsoft, ticker symbol MSFT. While Nvidia, Palantir, and SoFi are in the headlines every day, Microsoft is silently dominating multiple markets. Most know them only for Windows and Office software, but the company has transformed into a cloud computing and AI giant. Azure, their cloud platform, is now used by 95% of Fortune 500 companies and is reporting over 30% growth year on year. Microsoft's Office software, which includes tools like Word, Excel, Teams, etc., is used by over 1.8 billion people worldwide. And their gaming division is strengthened with the Activision Blizzard acquisition. But the story doesn't end there. Microsoft's recent $10 billion investment in OpenAI has already grown to $13 billion in just 2 years. Their free cash flow reserves are amazing. In 2024, they generated over $72.6 billion from a total revenue of $261 billion. That means for every $100 in revenue, Microsoft keeps $28 as free cash flow, consistently one of the highest margins in tech. This ticks our first checkbox. Second, Microsoft uses only about 25% of this cash flow for dividends. Rest, as you may know, goes into share buybacks, AI development, and growing their cloud business. Third, Microsoft has increased its dividend for 19 straight years, meaning that by December 2025, it will have completed 20 years without missing a dividend payment. The stock is currently trading at $420 per share. It offers a modest 0.7% yield and pays a dividend of $3 per share annually. So if you invest $100,000 into Microsoft today and reinvest those dividends every quarter, here's what happens. In 5 years, your annual dividend income grows to $5,920. In 10 years, it accelerates to $9,640. In 15 years, it compounds to $15,680. And in 20 years, it generates an impressive $25,520. I do understand that this is less than Visa's 20-year numbers, so please wait until I reveal the numbers of our next stock, which is Lockheed Martin, ticker symbol LMT. Lockheed Martin is America's largest defense contractor and a technology powerhouse. They build everything from F-35 fighter jets to satellites and missile defense systems to next-generation helicopters. With a massive $159 billion backlog of orders, strong U.S. defense spending, rising global tensions, and increasing defense budgets of countries worldwide, their future income is practically guaranteed. In 2024 alone, LMT generated a total revenue of $69 billion with a free cash flow of $6.3 billion. That number is projected to grow to $6.8 billion for 2025, meaning that for every $100 in revenue, Lockheed keeps $9 as free cash flow. Not impressive. Second, Lockheed uses 62% of its cash flow for dividends, higher than we typically like. But here's why that's not a concern. Unlike other companies, Lockheed operates in a unique position. Their income comes from long-term government contracts, often spanning decades. While tech companies like Microsoft have to constantly invest billions in R&D to stay competitive, Lockheed's R&D is largely funded by government contracts. Plus, with a massive $159 billion order backlog, they can predict their cash flow years in advance. This exceptional visibility and stability makes their higher payout ratio not just sustainable, but rock solid. Third, Lockheed has increased its dividend for 21 straight years, which is more than Visa and Microsoft. Their shareholders saw their income grow through the Iraq War, the 2008 financial crisis, and the pandemic. LMT's latest numbers show a dividend growth of 7.21% annually over the last 5 years, and an even stronger 8.79% over the past decade. When you invest $100,000 into Lockheed Martin and implement the DRIP strategy, your annual dividend income would grow to $9,860 in 5 years. In 10 years, those dividends accelerate to $15,140. In 15 years, that income compounds to $23,260 per annum. And in 20 years, you'd be receiving an impressive $35,740 per year. If you're not convinced about including LMT in your portfolio or disappointed with its numbers, I have a bonus stock for you. MasterCard, ticker symbol MA. Remember how we discussed Visa's incredible business model? Well, meet their equally impressive rival, MasterCard. They do everything that Visa does. They process payments and take a small cut from it. While Visa processes 65,000 transactions per second, MasterCard handles 40,000, making them an unstoppable duopoly in global payments. Together, these two companies control over 90% of all card payments worldwide. No tech giant has managed to challenge their dominance. Even Apple and Google Pay, they run on Visa and MasterCard's networks. PayPal partners with both. Amazon tried to ban Visa cards in the UK. They backed down within months. Even China's UnionPay struggles to compete internationally. Why? Because Visa and MasterCard have spent decades building the most secure, reliable payment networks in history. They process billions of transactions daily with near-perfect accuracy. Their networks are so crucial that when Visa went down for 10 hours in 2018, the entire UK economy felt it. Here's how MasterCard matches our retirement stock criteria. MasterCard generated $18.2 billion in free cash flow in 2024 from their $33.7 billion in revenue. That's a 54% margin, almost matching Visa's 58%. When you're processing millions of transactions with minimal infrastructure costs, profits pile up fast. Second, they use only 20% of their cash flow for dividends, even more conservative than Visa's 30%. This gives them massive firepower for growth, share buybacks, and future dividend increases. Third, they've been raising dividends for over 15 consecutive years, matching stride with Visa through every market condition. Owning both Visa and MasterCard is brilliant for 2025 and beyond because they're expanding into new territories where cash hasn't yet surrendered, like India, Africa, and Latin America. While Visa is stronger in debit cards, MasterCard dominates credit cards. While Visa leads in the US, MasterCard has a stronger presence in Europe. They complement each other perfectly. MasterCard is currently trading at $475 per share. They pay a dividend of $2.37 per share annually, with an average dividend growth rate of 14.54%. A $100,000 investment in MasterCard today could generate these annual dividend payments. In 5 years, your annual dividend income could grow to $7,340. In 10 years, it could accelerate to $14,480. In 15 years, it compounds to $28,560. And in 20 years, it would generate an impressive $56,320 per year. These numbers are slightly better than Visa's projections, which makes sense given their higher dividend growth rate. So, if you were disappointed with LMT, I suggest considering MasterCard. That wraps up our list of the 3 best dividend stocks for a dignified retirement. I hope you liked this video. If so, I have something special for you. I recently made a video titled 5 Best REITs to Live Off Dividends in 2025. If you're looking to add more dividend-generating stocks to your portfolio, consider watching it. I'll see you there.